welcome everybody. How are you guys doing today? We are on week number 5 of this 10-week program. And let's get started. Today we are going to be talking about managing cash flow, something really important because one of the things you don't want to do in your business is to run out of cash. And it is very important to keep an eye on the movement so that you can prepare for any fluctuations that come along. Remember that this session is being recorded, but not the breakout sessions. Today's agenda is very similar to last week's, and we are going to be talking. Give me 1 second. My dog is currently asking to leave, so let me open the door. 1 second. Okay, go on. I apologize about that. All right, so we're going to have a few highlights today and the speaker presentation by Carla Titus and the breakout session as well as the Q&A. For some reason, this poll is out, but we're not really doing this right now. So I apologize about that. This program is being funded by the EDA and by the cities, counties, government agencies, nonprofits, and foundations that support our work. I want to give you guys a highlight today for one of our MONEYmakers facilitators, Michael Couch. He runs a nonprofit. It is called Crossroads Communities, and they just received close to $2 million in funding to expand in Lebanon by providing supportive services and housing to those recovering from life changes. So please take a moment to congratulate Michael for such a great accomplishment. And now I would like to invite Mike Webb, VP of Commercial Relationship Manager in the Florence branch of Oregon Pacific Bank. They are one of our sponsors. And today he's going to talk to us about why they use a cash budget and why do lenders ask for one. Mike, welcome.
Thank you very much, Ani. This is something that ties into today's program. So cash budgets tell you or tell the bank how much money you expect to spend before you actually get paid for that. And it shows the gap in funding from the time of beginning production to the time you begin to get your money. It helps us determine how much or how large a line of credit should be. And it's one of the worst things a lender could do is provide a line of credit that's too small. If you get halfway into production and you don't get everything done, we've just lent ourselves into a real problem. So we want to make sure that the size of the loan matches your cash need and helps you actually produce what you're doing. So as you pay attention to the cash flow, managing cash flow within this program, you're going to see essentially what is a cash budget that forecasts what your cash needs will be over time. And it helps the bank tremendously. So that's what we do.
Okay, wonderful. If you guys have any questions, you're welcome to write them on the chat. And Mike will be here for a little bit to answer those. And if he needs to log off, I will anyway send those questions to him so that you guys know what to expect in that regards. So now let's continue over here. We're just going to talk a little bit about some housekeeping, essentially. So right now we are on managing cash flows. Then you guys come in next week to take a look at pricing and margins. And then the week after that, on September 1st, there is no class. So please remember that. The mentor hour for this session is going to be next Tuesday at 3 p.m. You should all already have a calendar invite. In case you have issues finding the links to join, they are all here. And this is a slide that I include on every single presentation. So that's a place where you can find all of that very handy. Next week, we're going to have different hosts for our mentor hours because I'm going to be out celebrating my birthday. So on Tuesday, for this mentor hour with Carla, we're going to have Aksa Khan. She is our Lane County Venture Catalyst and our Advocacy Communications Coordinator. You're going to be in great hands. Exa is amazing. And then on Thursday, for pricing and margins, you're going to have Nate Conroe as your host. He is the Lynn and Benton County Venture Catalyst and the tech wizard that handles everything behind the scenes while we are on our accelerator sessions. And also Robert is going to be hosting next week's session. Okay, so now let's introduce you to our guest speaker, Carla. Let me tell you a little bit more about Carla. She is a finance expert of over 15 years of combined experience in corporate financial planning, analysis, strategy, and she actually holds a job position right now doing all of that aside from having her own business, Well Worth and Within. She provides virtual CFO services. CFO is Chief Financial Officer. So essentially what she does is provide financial consulting to small business owners. And her whole mission is to be able to empower business owners to achieve the financial clarity that they need and the peace of mind so that they can get back to doing what they enjoy. And with that, I want to present you to Carla. Thank you so much for taking the time to be here.
Hi, thanks for having me. I see some spirit hands. I love it. That's the kind of energy we want around finances. We want to make it nice, fun, and enjoyable. I'm going to share my screen here. Hopefully you all could see it. Let me know with some thumbs up. Get everyone interacting here and asking questions as we go. Is it okay for them to ask questions as we go? I love it if it's like much more interactive. So I just want to make sure that works for everyone.
Sure, I can keep my eyes on the chat and,
awesome.
And I'll interrupt you.
Okay, that works great. I love it because then we can address concerns as they come up or just clarifications as needed. Also, well, thank you for that amazing intro. I'm gonna maybe skip a little bit through my own, but I'm here to teach about managing cash flow. I am a professional in finance, undergrad in finance, 10 years of corporate finance, consulting for 5 years with business owners. I'm just very passionate about making sure businesses are profitable and paying themselves a market rate and keeping some cash in the bank, which is what we're going to talk about today, which I think tends to be overlooked. And what happens is business owners get in trouble, they run out of cash and they run out of business. So we want to avoid that for your business and make sure that you're on top of it so that we can make better financial decisions from a position of strength and power. And, when you seek out lending or funding opportunities, you're not turned down because there's a lack of cash access in your business. We want to make sure that they're letting you borrow some money to grow and scale your business. And in order to do that, we want to make sure you have a strong cash position. So obviously, I have a lot of credentials, so I'm just not going to spend a lot of time there, but I just want to tell you a little bit about that background so that you know why I'm here to teach today. So let me know as we go through. I'm happy to slow down and explain any terms that maybe are not familiar, but I just wanted to start with a little bit of foundation. I know you've already covered financial statements, so I'm not going to go a lot into that in depth in that, but from an accounting perspective, I just want to cover some basics and make sure we're all on the same page before we move forward to the fun part. So, there's 3 financial statements: income statement, statement of cash flow, which is the one we're going to focus on how to not just utilize it for the day-to-day operations of your business, but also how you make decisions in the business on where cash is coming in and out of the business and how to manage that. And also start projecting out your cash to make sure that you're know what's going on and when money is supposed to hit the bank account, because it's not always when you make sales. So we'll talk more about that. And then finally, the balance sheet. I know some of you have some inventory-based businesses, so you might be dealing with the balance sheet side of things, inventory as an asset. We're not really going to go more too much in depth there, but if you have any questions, I'm happy to address it from like the cash flow projections perspective to see how that affects your business. Okay. So as all of you maybe already know, but if you don't, the statement of cash flow is going to report on that company's cash, healthiness or readiness in the business. And there's 3 areas that we like to track, from cash from operations, investing, and financing activities. So I'm going to break it down further because we will focus on this statement a little bit more, and then just give you a few quick highlights on what it is, how we use it, and then how do we start projecting from there. Okay, so managing cash flow. Every conversation I have with business owners really revolves around revenue or profit, but rarely do I hear a business owner think about their cash flow. And cash flow is just such an important part of doing business. It's the oxygen to your business, because once you run out of it, you run out of business. So that's the level of importance we should be giving it. But rarely do I see people managing it because it's not really talked about. You just kind of take it for granted that you will collect on, receivables, and the people will pay you on time, and that everything will work out perfectly at the right time. And the reality is that in businesses, that is never the case. Businesses struggle to pay the bills sometimes because they are owed money and doesn't come exactly when the bill is due. So managing that portion of the business gets a little bit tricky, but it doesn't have to be complex. We can simplify it, and make sure that you understand what's happening from those ins and outs in order to then make decisions going forward. And I see a lot of chat, but I don't think it's any questions yet. So we're going to keep going here. Okay, so from a cash flow perspective, this is what a statement example looks like. And it's very simplified just to give you a good idea. If you haven't ever looked at one, they can be very lengthy, especially if you're looking at a big company. But essentially, it's going to tell you the inflows and outflows of cash in your business at a period of time. And you can run reports from the past, you can run reports from current, and you can look at this as often as daily, weekly, monthly. If your business is in a healthy cash position, we're normally looking at it monthly. If your business is a little cash strapped or you're just starting out, we like to look at it weekly to ensure that there is no gotcha moments happening where you run out of money and then you don't know what to do. Also, it's going to give you a lot of insight into the financial health of the company. Just knowing where you're at, how much cash is in the bank, essentially how much runway you have before you run out of money. And knowing that is powerful because there's a lot of things you can do with that information ahead of that being a problem by increasing sales or doubling down on marketing efforts before you need the cash. And you have all these payments to make out to, for payroll or for anyone that you owe money to. It also allows you to manage, what available cash you have in the business. So if you have a strong cash position, the problem we have with some of the clients we work with is now they're like, I have so much cash, what do I do with it? And that is a great problem to have. Nonetheless, we still need to develop a plan and address that situation to make sure we're not just letting cash sit idle. For those of you who have inventory-based businesses, you might be planning for some working capital, which is the money that you utilize to buy inventory and make those big purchases, either monthly or quarterly, depending on the cycles. Sorry, was there a question? Okay. I'm going to keep going. And ensuring that you understand that you have to have some cash in the bank or working capital to be able to buy inventory so that you can make those sales. It's another aspect of managing cash flow in the business. So for those of you that don't have inventory and you're a service-based business, this might not be such a concern, but once you have cash in the bank, you need to decide what to do with it. You're going to pay yourself a profit. Are you going to do another distribution to yourself? Are you going to give your employees a bonus, profit sharing? Are you going to buy the vendor because you're tired of them not fulfilling your orders correctly and now you just want to take control of that company? You might be able to do that. You want to buy the commercial building so you don't have to pay a rent anymore. You pay it to yourself instead. Those are the type of questions we start to get into when cash flow is abundant and it starts to be fun again, because you're not worried about running out of cash.
We have a question over here, Carla.
Yeah, go ahead.
It's in regards to the investment section. Are you talking about external investments or what you have invested back into the company?
Yeah, so there's Those are two different things. So for the piece where you are investing capital into your business, that will be considered owner's equity, and that's actually stated in the balance sheet. So it will be a cash influx into your bank account, therefore it will show in your cash flow as well. But it is your money that you're putting in as the owner, therefore you still have that equity stake for that amount of money that you put into the business. So that's one. When investors put into money into your business, they are lending you money, maybe in the form of debt. They're expecting some equity share in return or portion of your company in return. So all that is going to also be managed out of the balance sheet to know which investor has what equity on your business. And then it's also going to become a cash influx into your business because you're getting money given to you by an investor. Now, that comes with expectations, as you all know. There's going to be some kind of return on investment the investor expects. There's going to be probably some reporting requirements that the investor will want to have in return for giving you this money. Just to get that money alone, there's a whole process you have to go through to land those type of funds. But there is ways to capture this on balance sheet and cash flow statement so that it gets reflected as money coming into the business. Okay, I see some more questions coming through.
Yes. So the investor tracking goes there, but not your equity.
They both go. You have owner's equity when you put money in, and then you have investors' equity if you given out equity for that investor money, or it could be a debt that you have to now pay back. So it still gets recorded in the balance sheet as a debt for the business to pay that investor back at a certain interest rate. So it just depends on that type of funding that the investor is giving you. It's either equity or debt.
Okay, thank you.
Do you want me to answer any other questions?
So here somebody asked if you could explain what a qualified investor, about a qualified investor, when is that applicable? She says that it used to be 150K available, not including home equity. Is that relevant here?
I think she's asking, and correct me if I'm wrong, but she's asking about accredited investors, and that is people that have $1 million net worth outside of their property or home that they live in assets in order for them to be able to invest in companies as angel investors. I'm not going to get too much into that because it's not a fundraising or funding conversation here, but I'm happy to just give some basics around who would be an accredited investor and like how that functions and how does that impact your cash flow or balance sheet.
All right, so we have a few more questions here, but if you want to continue a little bit more with your presentation, then we'll ask them in the next part.
Perfect, let's do that. Okay, so as we're walking through the cash flow, we are going to be managing cash very different than we manage profit or revenue. And I think this is where it gets a little confusing for business owners because they're like, hey, what happened to my $10,000 of business that I did this month? And they're like, where's that money? Why don't I have $10,000 in the bank? And sometimes what happens is timing of cash is where it becomes a problem, or it kind of gets disjointed from your expectation that you have on what should be in the bank, right? So let's say you made $10,000 in sales, but they haven't paid you and they won't pay you for 30 days. Then what happens is you won't see the money until the next month. And so that's where the reality of how you do business and what actually hits your bank account become a little bit different. And you need to be able to manage that timing, because that is a critical component and difference from the profit and loss to the cash flow is the timing on when money starts to show up in your business. And so be very mindful of payment terms. And we'll talk a little bit more about this in the next few slides, but payment terms really have a huge impact in cash flow, both going in and out of your business. So if you're extending terms to vendors or you're extending terms to your clients to not pay you for 30 days, well, don't expect to get paid for 30 days. So now you have to plan on how you're going to cover bills for the 30 days before you get that money from collecting those receivables. And that's why here we have your revenue, your receivables, meaning money people owe you, but you haven't yet collected. By the way, you should have a financial process to follow up with that and make sure you do get your money in the bank from anyone that owes you money. And if you don't have that, definitely set that process up of follow up. That becomes your cash influx. That's money coming into your business. And then you have outflows going out to suppliers, creditors, vendors, employees for payroll. Those are your cash outflows. And you need to be able to plan for that because some of those commitments you've already made. You hire people, you have them on payroll, you have to pay them, right? So that should be no surprise, and you should know how much, and you should be planning for that every single month. So you know you need to make more than your payroll costs in order for your business to still have money left and have some profit and be able to pay you. And payroll does include you. So if you don't do payroll yet, if you don't do an owner's draw, you should still plan for that cash outlay from your business to ensure that you're getting paid from your business. And then there'll be some investing activities if, again, you have some investors or banking financing happening. And there might be some loans that you're paying money out to as well. So there will be this outflows, again, payments out the door, as well as any money coming in from those investments. And what we want to look at here and why we want to look at it at least once a month is making sure that your cash balance in the bank equals the difference on inflows and outflows with the new balance at the end of the month. Why this is important is you want to make sure you're not missing cash in your business. Meaning, what happened to that PayPal account you collected money from and that you forgot to transfer the funds to your bank account? Now there's money sitting out there. You never brought it in. You wouldn't know unless you do this cash flow balancing exercise and notice, oh, I don't really have the balance I was expected to have. What happened? Was it my receivables? Well, I already knew I wasn't collecting on those. Was it money was out there and I forgot about it? And these things happen in real life. Just know as a business owner, there's going to be situations where, you know, you receive money for many different payments forms, maybe a check bounced, maybe a credit card was declined. You will not know that you're missing money unless you're checking for it. So this is the checks and balances piece that I always like to make sure business owners know about to ensure cash flow is working the way it's supposed to, and the balances are correct, and nothing is missing. Okay.
All right. Can we answer a few questions?
Yes, I saw the chat.
Good. So I'm doing them in order.
Okay.
Is there a difference? Like how does cash flow statement work for S Corps? Is there any difference there?
That's a great question. And I will say I'm not a CPA. I deal with some S Corps, and I haven't really seen that there's an impact as far as entity. It's really a taxation side of things where it makes a difference, how you're taxed and like your tax rate. And it will be something, you know, I would check with the accountant to calculate the difference in tax from like an LLC to an S Corp. As far as managing cash in the business, this applies to any type of business, any type of entity. It doesn't really matter. This is just how you manage cash flow in the business coming in and out. So hopefully that answers that, that piece of the question.
Wonderful. So I might need Ken to unmute himself to do this part. But he was asking, why is the total cash flow 50 different than the cash balance? I assume that 50, the only 50 I see here is the cash outflow. But I think, Ken, you need to clarify this question a little bit. Okay.
Oh, I think I might be able to help
Okay.
here. Ken, are you, so this is an outflow, meaning you have a loan payment and you have to make a $50 payment on your loan every month to pay back the loan that you've taken out. So let's assume you took out, I'm going to make it up, $1,500 for your business as either a line of credit or debt in some way, shape, or form. And this is just a payment that you're making back to the loan every month that is due as the minimum, or what you're required to pay every month, interest only, interest plus principal, whatever that was that you agree with the bank or the lender. And so this is going to be another outflow. So you're going to take that the influx of 1,200, the outflows of 650, you're gonna add that plus this, and that's your total net cash flow. Then you want to take your bank balance, add that back into it to know what your bank balance should have been at the end of the month. So hopefully that walks through how the numbers work out and addresses that $50 payment for the loan.
Awesome, thank you.
Mhm.
How do equity accounts relate to the percent ownership of a company? In their case, it is a partnership that is 51% woman-owned.
Where's that question? I'm trying to find it here. I want to make sure I'm following. Equity account.
It's up a bit before Ken's.
Yeah, I see that. Adrian, do you want to leverage a little bit more on that? What is exactly the question do you want me to answer?
So my husband and I are co-owners of the
Okay.
business, and
Yeah.
when we did our application or filled out the paperwork for the state,
Yeah.
it's 51% woman owned, and he's put a lot of cash in, and I put a lot of credit in. So we have these equity accounts, and I'm just curious, how do those equity accounts relate to percent owned? I've never understood it. And there may
Great
be no
question.
relationship whatsoever, but yeah, so if it's a rudimentary question, I'm sorry, but
no, it's not. It's a very complex one, actually. And there's a lot of layers to it. So I don't want to get too far into it, but I'll just give you like a good high level. And then I definitely want you to seek additional support and advice from someone who deals with equity specifically, because it is very complex. So you still have the ownership of 5149. So anything that the business take on as cash or debt will be essentially hold that way, the 5149. Now, if your husband is acting as an investor into the business and also is a partner, you can track how much cash he's put in from an investor perspective while still holding his partnership. So that's where it gets really complicated. And I want you to seek additional advice on how you should track that on your balance sheet to ensure that the owner's equity, from whatever perspective you want to have. If you're just thinking like, hey, we're all putting stuff into the business and it's all equal, it's still the 5149, and there's no additional, math you have to do on that. So, but again, I'm not an expert in this area, so I'm just giving you like what I know from what we've seen with other clients that we work in. But especially for the women-owned 51%, this one is really important that you get it right, because a lot of funding and programs for women owned specifically look for this 51%. And if that is not the realistic, funding or things that have happened behind the scenes, they might question whether or not it is 51% of women owned. And we don't want to be in that situation. So from that perspective, I want to make sure you're also, getting the benefit by having the ownership reflected in the financials as well.
Okay, awesome.
Hopefully that clarifies. Yeah, just a little direction. I'm not an expert in that area, but I definitely know that it can get very complex. So thank you for that question.
All right, thank you. So there are more questions, but I think we need to keep going on the presentation. And
yes, please keep me on track, because there's a lot we're going to cover today, and I want to make sure we get to it all. Okay, so staying cash flow statement, so I'm not going to cover that, but what I want to start to talk about more is making sure that you know how to start using this to manage your money. And we're going to do a breakout, to go in further into detail. But we want to make sure that you have the accounts receivable. And we talked about having a process for collecting on those, right? So making sure you have follow-ups on your invoices. If you don't collect everything up front, meaning like when you sell something, you probably get paid right away. But in some cases, if you're delivering a service or some type of thing that's a later payment, you need to make sure you're following up with those after you have delivered a service. Otherwise, there's an outstanding receivable that might never get collected. And there's ways to manage that in a business. I'm not going to get into that today, but you need to make sure we have that process. Okay. we talked about payment terms, right? Both extending payment terms out to people, meaning like, hey, you don't have to pay me for 30 days, but let's just have you join our, service right now. Or let me give you, 100 units of that, and then you pay me in 30 days. Again, payment terms really impact cash. So I need to make sure that you're mindful, both asking for payment terms, which is another one. Like if you work with vendors or suppliers and they know that you're good for it, you could start asking, hey, can you give me 30 days to pay you, 60 days to pay you? And they can say yes or no. But this is an aspect that we manage for our clients to ensure that they're getting extended terms as they do more business with the same company. So something I just want you to keep in mind and utilize in your business. Now, if you are not paying attention to cash, cash will get your attention when it is not the greatest time or when it has run out, and then it's a little bit harder to recover. So I want you to be watching your cash flow, not every day, obviously, but making sure you understand how that's working in your business so that you can better manage it. Determining cash runway, and like our friend here, banker, mentioned, Mike, they're going to need a cash flow forecast because they're not going to be able to give you lending unless you understand what's happening with cash for the next 12 to 24 months. And this is an exercise we do a lot for our clients that come to us for funding. They need a cash flow projection. And it's something you can do yourself if you know exactly what are the ins and outs that you expect as the business continues to grow and the plan that you have to accelerate that growth. Knowing what are your monthly burn rate in the business, meaning what does it take to run the business expenditure wise, it's going to really help you better plan for cash, because now you know, hey, I need to make at least this much in sales and collect those, to ensure that I have enough money in the bank to cover my expenses. So that is really helpful to know. And again, in the exercise, we'll go through that. If cash flow is tight, my recommendation is focus on increasing sales and reduce as much of the expenses as you can, even temporarily, because I think people get caught up on like, well, I have to just cut it off and never again would I be able to afford XYZ. No, maybe it's a 3-month pause on something that you were doing that helps you recover on the cash side, and then you can start doing it again. So think of some changes that you can make temporarily, as well as some permanent ones needed just during this tight period. And then doing your weekly projections will help you understand when it's time to bring those expenses back in, or when it's, cash is looking better and you have a really good trajectory going forward in the business. Okay. And then we're going to talk about planning and projecting your cash flow next. And I want to make sure we cover this before we run out of time. How am I doing on time? I think I might be a little tight here.
We're doing good.
Okay.
I'm writing down all of the questions people are asking so that we do that after you're done with this part. That way we
Excellent.
cover all of the content and still have some time for questions. And
yes, that sounds great. Okay, so let's go into projections. So this is where a lot of people come to get some help on it, but it is something you can do yourself. And the more you do it, the better you'll get at it. The reason why I get paid to do projections is because I'm going to be probably more accurate than most people because I've been doing this for a while. But if you start now, you'll have the experience and you'll only get better and better at it. So what we use forecasting for is for planning purposes. We want to know and estimate what the future might be and the trends that we might start to see in your business as it starts to grow. And it's something you are predicting. So it's by definition going to be wrong. It's really how wrong are you going to be and how close to reality can you get? But don't think of it as it has to be perfect. Forecasting is never perfect. There's always a margin of error. It's just how small can we make that margin of error over time? We will do forecasting for planning purposes because unless you have a plan on where you're going, it's really hard to get to it. So start thinking about what are the things I need to do in my business to start planning out these results that I want to get, and then work backwards. And so planning for not just cash flow, but in general in your business is going to become very helpful to helping you reach your goals. Now, if available, we love to use historical data as a baseline to start. Now, the past does not mean that is going to be exactly the same way it's going to happen in the future, but it gives you a lot of insights into what's happening, what has been done, what is possible, and where maybe you need to double down. And then we use that as a baseline to predict future trends in our business cash flow and planning in general. Now we do mostly monthly cash flow for our clients because we have a cash runway. So we're not really working on cash as much anymore. But if you are just starting out or you have a tighter cash situation because maybe you have an inventory business or heavy on the working capital, then you want to be looking at it weekly to make sure you're doing just fine and that you're not concerned about cash, because again, cash will get your attention if you don't give it attention. So make sure you know where you're at. If you feel comfortable and you have a runway, move on to better things. We don't want you spending a lot of time on this if you don't have to. So we talked about that cash cushion being important. We want to have a runway, right? They say 3-6 months of business expenses is always helpful to have. And depending on your strategy for growth, you might have less because you might want to invest more in the business and the growth of the business. So just depends on what lets you sleep at night, what do you feel comfortable with, and what are the requirements of your business around maybe some working capital for inventory and things that you need to consider, that the business needs that are non-negotiable. Now, we do comprehend expense and debt management into cash flow because you have to make debt payments and there are expenses of running a business that you need to take into account. So those are areas we want to make sure we are accounting for as well. I see them left out a lot where they are just looking at, oh, okay, here's payroll, here's rent, internet bill, whatever. And then they forget that they have to make loan payments. And then once they add those in, cash flow does not look very good. So it's something to be mindful of so that you can then do something about it and, work the other side of the equation, which is generating more revenue or sales. Also making decisions around investments and the timing of them. Today might not be the best time to go after that big commercial building, but then when you have enough cash runway and you have a healthy down payment, your cash flow statement projections will show you when that is. And if you hit those goals, then that might be the time to go after that big financing opportunity. So again, it's just going to give you more information for you to make more informed decisions in your financial side of the business. And we do all of that with the data we have. And so the more data we can put together, the more, we can go into the projections, the better we will be able to make our business stronger, more resilient. And, there's talks of a recession coming. Who knows what's going to happen? Honestly, after COVID, businesses were just not set up for success and they were running low on cash. And a lot of people went out of business because of it. So I always say, keep your cash cushions and be prepared. You never know when there's seasonality in your business is going to happen, or when, things or trends will change in the industry and maybe sales go down unexpectedly. You still have to make payroll. Like, you can sleep at night knowing that you have a cash cushion and that you're not going to run out of business because you don't have cash in the bank anymore.
Carla, is that any recommendation you have of how much cash to have on hand?
Yeah, 3 to 6 months of business expenses is normally where we like to be. Some more capital intensive business might even choose to go as long as like a year worth of reserves. It just depends on like the type of business, the seasonality, and the demands on cash to be able to generate a business in the type of business, meaning like goods versus services, right? Because the service business has much more room for error, bigger margins, not a lot of capital intensive cash needs. So then you can probably be on the lower side of reserves and be perfectly fine.
Wonderful, thank you.
Awesome. Do we want to go on to the exercise breakout?
Actually, we have a few minutes to answer questions before we go into the breakout. So I would like to ask a few of them.
Yeah, let's go for it.
Bear with me, as sometimes I don't even understand the question very well, but you do, so.
You're fine.
Will the payment of a loan be the same as borrowing money from your savings, but now want to start paying this back? I think this is when you're doing some personal contributions to your business.
Yeah, so there's a distinction between taking out debt for the business from, let's say, a banking institution or a lender, where you're making payments back to them with interest, right? That's just normally how that works, versus when you as a business owner put money or cash into your business. So when you make a deposit from your personal funds into your business, that gets tracked as an owner's equity contribution. There's cash that goes in from your personal bank account to the business. That's an owner's equity contribution, and it gets tracked as equity. So if you decide to then pay yourself back, that becomes an owner's draw. So that offsets the equity you have and gets tracked as an draw. I mean, the equity stays there, but the draw part is how you get paid if you're not on payroll. If you're paying yourself back as a loan, then it should have been categorized as a loan, not as an owner's equity. So that's, I think, where it gets a little muddy or confusing. So make sure you understand, is this just money I'm putting in as the owner to increase my equity in the business? Or is this money that I'm lending the business that is going to pay me back in the form of debt? So I become the lender and I also own the business. So they're different relationships, and we track them differently in the financial statements depending on what the answer is.
Okay.
And somehow I got kicked from sharing. So, or maybe Annie, you were going to share.
Oh, since we're answering questions, I just thought it would be nice to have a little bit of FaceTime.
Yes, you guys can stare at my face now.
All right. So what are typical vehicles for earning on cash that you know will need to be used within the next 12 months? Bank accounts are practically null, and capital preservation is extremely important.
Let me find that question so I make sure I can follow along. Who was that, Annie?
I just copied the questions. I don't really write who.
It's okay. Can you say it one more time? Just want to make sure I get it.
Yeah.
I can give you a little more context on that.
Yeah.
Okay.
So I think what they're asking about is they have cash that they need to protect, and they're looking to earn something with that cash. So they're saying bank accounts aren't paying anything. Is there
Yes.
is there a way to use that cash and still protect it and earn a little bit of money, a little bit better money?
Yeah, I mean, it's really rough right now. I'm not gonna lie. Interest rates are, the lowest I've seen on bank account holding your cash. So obviously you're not gonna make a lot of money from that. I know there's some online savings accounts that people use sometimes, both for personal or business. You can open it in the business name, with some online banks that give a little bit better rate at like 1.5%, which is still horrible, right? So other than that, you're really looking at potential investments longer term, and I would be worried to tie up my cash for the business in a long-term investment unless I'm very certain that I will not need that cash anytime soon. And obviously you can invest in other businesses as well that maybe might make you money, but again, there's a risk reward that you need to balance here. And I would say first take care of yourself, make sure you have enough cash in the business that you feel comfortable. Now the extra cash, what you do with it is up to you on getting the return. But honestly, anything that you will get a return higher will be much more risky. And if you need to pull the money out at a time that you need it for your cash business needs, it might not be the best time for that investment to mature or give you the yield that you were expecting. So it's maybe not even worth it to look for that. And interest rates will come back up on bank accounts. So it's a matter of time and like what's happened economically. So we gotta, think about that. And trust me, I'm sitting on cash and I'm thinking, what should I be investing in or doing with it? And then at the same time, I'm like, well, an opportunity will come and then I will make a decision on that. There's also things you can do inside your business. Maybe you want to take a leadership course. Maybe you want to put your employees through some upskilling or, additional skills that they can acquire so they can be more valuable to your company and bring more ROI to your own business. So think about internally first of how you can also invest that cash before you go out and try to get, some kind of interest rate for it just sitting in the bank.
All right, wonderful. So for those that are using cryptocurrencies, can they treat it as cash or as investment?
Great question. And I, to be honest, have not come across that yet. I'll just say, openly, like it is a risky side. It's newer. You've seen what the crypto market has done. So you are taking a bit of a risk having some of that as far as like how you use it in the business, unless you can easily liquidate that crypto into cash. To me, it feels more like an investment, which might or might not be available when you need it as far as like converting to cash. So, if you want to be more conservative, you would have that in cash instead of crypto. But obviously everybody has their own feelings and thoughts around risk. So you manage it however you think is helpful for your business. And if your business operates in cryptocurrency, this might be something that you do have to have money into to be able to operate. So it depends on the type of business and what you're trying to achieve with that. If it's just a form of investment, I don't consider it the same as cash, just because if you liquidate and all of a sudden the crypto market crashes, you're not going to have the same amount. So it's just something to keep in mind, right? Or you might have double the amount. Who knows? It could go up or down. It's so volatile. So you have to manage that volatility when the cash needs come into the business, unless you're able to pay your vendors, suppliers, and anyone you owe money payroll in crypto, then, take your own risk level on that.
If I could add a little bit,
Yeah.
perfect answer. I just add that I think if you are considering crypto like cash, you can account for it that way, but it would probably fall under the same accounting requirements as foreign cash. So if you've got a business that's working in multiple countries, they will have cash balances in different currencies. And it's a pain because every time they report, they have to reset the exchange rate and account for that in their, on their balance sheet. So it is a pain, but that's how you handle it if you have foreign currencies, and I would imagine it's similar.
Yeah, and you have tax implications on top of that are very complex as well. So make sure you have a really good accountant that understands crypto by your side if you're going to go down that path.
All right, wonderful. Do you have any favorite cash flow projection tools?
Oh, I try them all. I'll be honest, like I keep going back to spreadsheets for the flexibility and the ability to be able to model the way that we want to see things that works best for the business owners we support. I do use a few software tools to kind of enhance. It's hard to manage cash flow projections when you cannot code the underlying formulas behind what's being projected. And most of the softwares will not tell me what they take into account when they're forecasting their cash flow. So I know there's some tools that have worked well for clients, just cash flow, tools that they can plug into and play, like Flow and, others. I know even QuickBooks has like, here's your cash projections looking for. But I don't really rely on that. I use it as an addition to what we do for our clients, because where cash flow projections become useful is when you know more about the business. And by partnering with my clients, we know exactly what's happening in the business and can better project cash flow. Those tools are not going to know, right? They're just going to take historical data and project to the future, no knowing if things are going to completely change. If your business is going to double by the end of this year, they wouldn't know that. And unless you have the ability to tell that to the tool, it's really hard to get the right results out of it. But if you're like, hey, I don't have time to do this, and I'm just going to plug into a tool and utilize whatever I get out of it, it's better than having nothing. So I say, go for it, try it and see how it works for your business. Just don't waste a lot of time or money getting those up and running.
All right. And then let's do one more question and move on to the breakout activity. Do you use any kind of formula to help calculate a safety buffer for your cash? And does it change as the business evolves and stabilizes?
Yeah, we always do multiples of expenses, and that's all inclusive, meaning like the run rate of running a business. We said 3 months, so that's like a 3 multiple on what you spend monthly on running a business. If you're projecting your business is going to double by the end of the year, you probably want to have, double the new multiple. So like if your run rate of expenditure is going to be no longer $2,000 a month, now it's going to be $10,000 a month, then I want you to have 3x 10,000, so 30,000 in a buffer. But you have to know what trajectory your business is taking so that you can then plan better for how much cash you need to have. To again, let you sleep at night and make sure that you're running a healthy cash, based business and with the right cash cushion by your side. So you can use multiples so that way you're not on a fixed number. We sometimes, we'll look at percentage of, sales just to see, how things are going. So, it's really up to you as the business owner, what is going to let you sleep at night, and how much do you want to make sure you're protected from any unexpected. And if you have to make payroll, maybe you're even more inclined to have enough, payroll cycles in the bank that you feel that you're not strapped for cash when that time comes. Because I've seen that often with payroll intensive businesses.
Okay, thank you. You guys can continue to do questions on the chat. I know that once we go into breakout activities, you can only write on the general chat. So I'll be monitoring that as well. And then when we come back from the breakout activity, we'll continue to do the Q&A. And now, Carla, would you walk us through the activity?
Yeah, let me see if I can share again. Something happened that stopped the presentation. So I'm just gonna get back to it and see. Here we go. Okay, I'm gonna hopefully let me share here.
I just put a link on the chat for those of you that want to access the spreadsheet. Just make sure that you click on file and then copy so you can have a working document.
Yes, file, make a copy, and then you can save it as your own and start utilizing it. Okay, so we are going to go through a monthly cash flow exercise for everyone's benefit on not going too detailed, but this is the same exercise you would do for a weekly view. And I have included another tab in the bottom that has the weekly. And again, it behaves the same way. The time period is a month versus a week. That's the only difference. So a lot of things can happen in a month, and maybe a lot of things can also happen in a week from cash flow. And we mentioned sometimes you want to go to the week view if you feel that cash is a little strapped and you need to have a little bit more control of what's happening. Okay, so we are going to forecast our cash flow. So in order to forecast, first we have to understand where we stand today. So what we're going to start with is, what is our cash balance today? And that is any bank account balance that you have. Let's say you have $7,500 in a checking account, $1,820 because you save for your taxes. And so you have some money there, and you have another third bank account, maybe you keep profit there, whatever, for whatever reason, and it doesn't have any money on it right now. So you want to take your bank balance today, and then that's going to be your starting point. Now, for the month of July, you might have some sales that you've done previously that you expect to come in on that month. And so we are calling that receivables, so what people owe you. And we'll just say it's about $1,000 that we expect to come in between now and then. Then for my inventory-based businesses or goods businesses, you're going to have cost of goods sold. And I know we can go down, a little bit farther here with inventory management and such. We don't have time to cover that today, but we do want to make sure that you're planning for your purchasing cycles. So let's say you need $10,000 of inventory in September that you're planning for. We need to make sure you have enough cash in the bank to cover that. So we'll be able to start using this to plan. And then I'm going to keep going and come back to, the change I just made and how that impacted cash. Then you're going to start to look at all your expenses. And this is not a comprehensive list, but you can make it a comprehensive list. What does it take to run your business? You have payroll, other operating expenses. And I do not like to get super granular. You can get down to the line by line item, my Canva subscription, my QuickBooks bill. I kind of bundle those up into operating expenses if they're smaller, because I just want to get a good idea of how much cash flow am I going to be utilizing this month to run the business. But I really focus on the bigger categories, which are the more impactful ones for your cash flow. And then you want to save up for taxes. So you might not be sending in a quarterly payment right now, but you do want to set this aside into hopefully a different bank account like we have here to plan for that tax payment that's coming up in September. And then you'll add those up. In addition to that, you want to make sure any debts or any payments that need to be made out to lenders or loans that you've taken out are also accounted for here. And I have 3 spots for 3 different loans. You might have more than that. So capture those payments as well. So that will be the outlays for debts. And then you'll have your net difference on what happened once you took all the money you have today, all the projected outflows that you have for this month, and what's left at the end of the day. Well, in this case, it's a fun day because we have $2,300 left. Yay, we're positive. That's always good news. And we're going to add that to our balance that we started with and say, hey, now our bank balance by the beginning of the month should be $11,640. Now, this is super helpful because the farther you go out, the more you start to see on when are things going to change and do I need to increase sales or what's going on with my business, and start making decisions based on that. So let's say in August, you made about $10,000 in sales. And the reason I track sales here is not a component of how cash comes in, but it's an indicator of when cash might be coming into your business. So let's say you made a $10,000 sale and you collected 8,500 of that, and you expect the difference next month. And, again, depends on how you collect. 50% deposit, 70% deposit, 90% upfront, and then 10% on the back end. It just depends on the payment terms you extend. So let's assume that you have $8,500 that you're expecting to collect in August from business that you've done. You have maybe no inventory payments this time, but you are planning for one in September. And then you have some, again, running the business operating expenses that keep coming up in the business. Maybe you grew so much that your accountant say you're going to need to send a bigger quarterly payment in September than you expected. So you got to save up a little bit more than you were before. So now we adjust for that here. And then you have, maybe you have another loan payment that it's due again because you're paying on that. And then your net change of cash total at the end of all that is $500. You're like, yay, okay, I get to add $500 to my balance. And just keep working all your way through, however many months you want to go out. Now, remember, the farther you go out, the more uncertainty. So like doing, a 6-month, 12-month cash flow forecast, easy, quote unquote, 24 months, that's where it starts to get interesting, right? And some banks want to see that 12 to 14 month projection. So this is how you would put that together.
Carla,
yeah.
for businesses that are tiny, that don't have a lot of expenses or don't have a lot of sales coming in, do you still recommend they use a forecast for their cash?
Yes, and actually, you probably want to use it even more so because every decision could make or break your business, especially when you're just starting out. Unless you have a personal, finance or personal wealth that you're willing to tap into and you have no problem putting in money into your business every time you run out, it's even more important that you start looking at when do I run out of money if I'm little, and making decisions about spending or not spending money on things, right? And this is going to allow you to do that because you might not have the cash for it. You might have to say, hey, in November, I'm going to have to put in $4,800 of my own money in order to make this work. Am I willing to do that? Maybe I just want to go make more sales instead. So, and take out the zeros, right? Like this could be a $500 a month business. It doesn't really matter the size. It really matters on like how we're managing to be profitable and how we're thinking about cash cycles as we go through month to month or even week to week. Like we said, we're not on the week one, but it essentially works the same way.
Okay.
Yes, go ahead.
No, I was just going to say thank you so much.
Yeah.
All right. So do we feel ready to go into breakout rooms? Because we kind of have to.
Yes, let's do it. Sounds good.
All right. I wrote all of your questions, guys, so they're still here. Yes, Robert.
Yeah, I'd just like to make a point. I love this cash flow worksheet, the forecast worksheet. We were talking earlier about the statement of cash flows, and it is one of the three main cash flow or financial statements, and it's a confusing statement. It shouldn't be, but it is. But what I love about this cash flow forecast worksheet is you should think of this as the simplest possible worksheet. All you want to make certain you put here is the money that's going out. The money you project will go out, and the money that you expect to come in. And granted, it's more complicated than that. But if you think of it in just those simple terms, this is what I actually expect to get in cash in this month, and this is what's going to be going out. And just focus on what you're going to be spending on. This can be incredibly valuable. So don't let this confuse you at all. This is a great worksheet and expresses the simplicity of this process.
Thank you.
Thank you, Robert.
That was the hope.
You guys can always make more copies of the sheet, and just if you screw up once, it's all right. You can just do it again. Okay, so let's go to the breakout rooms, everyone. If you are not assigned to a specific room, you're welcome to stay here with me and Nate. We will pause the recording so that way you are able to still.
How would benefit the business, right? Like if it would be like what would be like what would we need to charge? Because I have examples of my work, but I don't have examples of that new person's work and what I would need to charge the client. It's one thing is when you're trying to.
Sorry to interrupt you, but I think we need to move this conversation potentially on email.
That's fine.
So that everybody because we already closed the breakout rooms and we have everybody back in. So we need to answer a few more questions. And I think we can follow up on either on email or on the mentor hour. I think will be a good time to be able to discuss this part. So that way we can all take advantage of it. Okay, so we started the recording. Let's do this. I am going to share my screen here so we can give you guys, there's not that much that we need to cover after this. Let's see. Okay, bear with me, I'm almost there. There we go. All right, so next week we're gonna be talking about pricing and margins with Paula Hayes. She is the founder of Hue Noir. It's makeup company. They actually do all of their manufacturing in-house. So she's gonna have a lot of great insights on that process. And just as a reminder, the kind of things that you guys need to graduate is at least attend 8 out of the 10 sessions that we are doing. And if you miss them, just send me 3 takeaways from the recording or something that you learn from that speaker that you are implementing now on your business. Attend at least 3 mentor hours, submit the takeaway forms. This is always the same link. So you guys can always go to any of the slide decks and get that link from there. And next week, we're going to be announcing our keynote speaker for graduation. Do know that you guys are going to be competing for prizes. Some of these are cash prizes. Some of these are going to be more of consulting packages and things like that. And you're going to be able to invite all of your friends and families and people you would like to share that moment with. And with that, we can continue now on the Q&A session. As soon as we get to 10:30, I will stay over here for 10 to 15 minutes to answer any questions that you guys have. And you're welcome to stay or you're welcome to log off at 10:30.